Welcome to the Bullish Money YouTube channel. My name is Josh and it is hot as hell. I don't know where you guys are, but here in California, my goodness, I mean, it's like, when I checked my thermometer, it was like 103 degrees. And here in the coast, I think it calmed down to about 86 degrees or something, but in inland, my goodness, it is just scorching hot. And even just walking on the sand here, it's like walking on a fire pit. I mean, it's just absolutely incredible. The heat is just something else. And you know who else is feeling the heat? Is Wall Street, because you know, they're playing that game again about, oh, we made 390 points yesterday when trading resumed on Tuesday right after the Labor Day weekend. You know, I think the Dow Jones shot up 390 some points. And everybody's like, yes, we are back. We finally made it. This is nothing more than just a little blip on the radar. But the thing is, today, you know, you can see that, you know, the Dow lost about 1.6%. And the markets really aren't going anywhere. Here's the thing. The markets right now, they're forming what is known as a bearish pennant formation. A bearish pennant formation is simply a consolidation phase. It's a negotiation between the bulls and the bears, with neither side really determining the ultimate trajectory. Right now, it's a neutral phase. It's a consolidation phase, neutrality. The thing is that it's called the consolidation phase because it's a respite from the dominant trend. In this case, the dominant trend is still very much negative. That's why it's considered a bearish pennant formation. It's a pennant also because it's shaped like a triangle. And the consolidation phase, what's occurring is a very classic definition of what we would call a bearish pennant, meaning that the trading range is narrowing while the volume itself, generally speaking, is declining. And at the culmination of a pennant formation, in this case a bearish pennant formation, it's a continuation of the dominant trend. Again, if the dominant trend is bearish, which it is in this case, we can expect fairly shortly that the markets will resume tumbling. And the other major risk factor here is that even though there's been a big move up in Asia over recent trades following the Labor Day weekend, these token moves upward in the Asian markets, like, you know, in Japan, I think the Nikkei 225, it jumped up yesterday about 7%. But even so, it doesn't make up for the dramatic losses that we've seen, especially in the Shanghai index. I mean, the Shanghai index still is negative about 40% from its very peak back just a few short months ago. And it's still very much in the red when you look at the dominant trend that's been forming in the technical charts over the past few months. And so getting a 5% move, a 6% move, a 10% move even, it really doesn't matter. It really doesn't, because losing 10%, or excuse me, losing 40% and then gaining 10% back, that doesn't do anything. You know, you're still well below where you need to be. In this case, with the Asian markets, the fact that their markets have gone so much, that's just speculative, dumb money pushing up the valuation of an equity sector that fundamentally is not sound. I mean, you know, when you look at China, you see all these skyscrapers everywhere that are just absolutely empty. And then in the real estate market over in China has collapsed. I mean, again, you see a lot of development, you see a lot of building stuff, but there's nobody occupying them. There's no demand. There's a lot of supply, but there is no demand. And I think that really is going to be the motif over the next few days and over the next several weeks. The Federal Reserve, the US Federal Reserve, they can, you know, talk about raising interest rates or keeping them artificially low however long they want to. I mean, they can do whatever they want, but ultimately fundamentally, you can't deny the free market dynamics for too long. I mean, we can, paper over some of the problems and perpetuate this artificial lie for a year, 2 years, maybe 5 years, 10 years. But at some point, when there is this enormous imbalance between supply and demand, remember supply and demand, this is economics 101, when there's such a gross imbalance between these two factors, at some point there will be a correction, but it's not going to be an orderly correction. It's not going to be like, okay, we're going to reshift the balance back to equilibrium in an even manner. No, it's going to spike up, I mean, it's going to be this dramatic overcorrection, because that's how markets work. I mean, remember, markets are about human psychology first. So there's going to be an overcorrection before there is a correction back towards a more equilibrium state. But right now we're not there yet. We're at this point where we're still kind of playing these these crazy games, and we think we can paper over some of these problems. We're still in a very much a denial phase. We're still very much at the beginning of the volatility. I mean, you think you saw some volatility back a few weeks ago. You haven't seen anything yet. There is going to be, as I mentioned in my epic Wall Street rant, there is going to be a severe reckoning, and you must prepare yourself financially, personally as well, for this unprecedented crisis that we are about to hit upon. I know that there's a normalcy bias there, that people don't want to believe that, because right now, as you can see, it's a beautiful day here in California. The clouds are out. People are out enjoying, beautiful time, beautiful weather. A little bit hot, but nevertheless beautiful weather. You got the birds, seagulls there. People are surfing and stuff. I mean, things are normal. So why should we believe that there's going to be a 10,000 point drop in the Dow? Well, because we've been living a lie for quite some time. We have been living a lie based on speculation, based on just dumb money, just pure, dumb, wasteful, speculative money, just artificially pumping up market liquidity, market valuation. And because everybody else is doing it, all the zombie traders, because everybody else is doing it, really there's no need to, rock the boat, to throw stones in a glass house. But as soon as somebody wakes up within that upper echelon, within the social elitist group, as soon as somebody, one person, throws that stone in their house of glass, one room starts to shatter, another room starts to shatter, then you got multiple rooms starting to shatter, then eventually the whole foundation comes crashing down. And if you haven't got your money out of that structure, I urge you to consider, not to do it right away, based upon my words, but to consider, to do some research, but to consider getting that money out of that structure before it all comes tumbling down. Because once it tumbles down, you're only going to get pennies on the dollar of your retirement fund or of your investment portfolio. And that's not really something that you want to do, obviously. You want dollars, not pennies. And that's what I'm trying to do. That's what I've been trying to do over the last few videos that I've been making and producing. And it's just to convince people you want your dollars, not your pennies. And the only way you can get your dollars is getting out before the panic sets in. Because I'm telling you, once the panic sets in, my friends, it will be too late.